May 2018, part of question 1. Okay, part of question 1. So what are we told to do? When you look at this part only, it is going to help you. It's going to help you now. We are told that included in the furniture is a specialized piece of furniture that cost shillings 1.5 million. This piece of furniture was later found not compatible with other furniture that is used for the same purpose. BUL intends to dispose it of, and there exists 2 different active markets for this piece of furniture at different prices. BUL assessed its price in 2 markets on 30th April 2018 as given below. You have Seku market and Dembe market. You have the prices to be received, you have the transaction costs, you have the transport costs. You are told that Seku market has the greatest volume and the level of activity for this piece of furniture, and you are advised to measure this specialized piece of furniture at fair value. So basically, we are trying to determine the fair value of this furniture. That's what we are trying to get. The fair value of this furniture. So how do you get the fair value of this furniture? Okay. Now, I want to highlight something again. When you're talking about the principal market, when you're handling this standard, IFRS 13, you need to know whether in the question you are given the principal market. You are given principal market. If you're not given principal market, then we are going to look at what we call the most advantageous market. So we need to know what is the meaning of a principal market. It's very, very key. What is the meaning of principal market? And what is the meaning of most advantageous market? Principal market is normally the market in which the asset is being transacted with the highest volume and the high level of activity, compared to any other market available for the similar transaction. So that's how you will know the principal market. We are going to look at different markets. For example, now look at Nakasero, Nakawa, Chireka, all those markets. Now we'll be asking ourselves, among all those markets, that asset is most traded in which market? Where we sell more, okay? Where that asset is being transacted with the highest volume, where you go and find that there are a lot of volumes for that asset that is being traded in that market. So that one will be the principal market. If you realize that in the market, let's say A, that item is not all that, or that asset is not all that much there, then you cannot use that one as principal market. Don't, when you're looking for the market of, let's say, Matoke, you cannot go to Karamoja. Karamoja,
Yeah.
the volume, the volume of Matoke that side is not all that much. So the principal market, you look for the market where that asset is mostly transacted. Okay, that will be your principal market. Then if you cannot get the principal market, then you will look at the most advantageous, because you may find that things balance. You cannot tell where this asset is being transacted with highest volume. Okay, so in that situation, you're going to look at the most advantageous market. You're going to look at the most advantageous market, and this refers to the market that maximizes the amount that would be received, sell the asset, or minimizes, sell the asset or minimizes the amount that would be paid, transfer the liability after taking into consideration, after taking into account, let me just say, into account the transaction costs and transport costs. So that will be your most advantageous market. In a situation where we cannot find the market where that asset is over transacted, or is transacted with the highest volume, then we are going to look at another market where we can actually gain more. If you were to sell your asset, where can you gain more? That will be your most advantageous market. But you cannot look at gain or benefit when you have the principal market. The principal market is the main one. But in a situation where you cannot tell the market in which the asset is being transacted with highest volume, then we just look at the benefit. If you sell your asset, where can you benefit more? In which market? So in that market where you benefit more, you will ask yourself now, if you transact in that market, what will be your transaction cost? What will be your transport costs? So you look at how the money you're going to receive, then minus those transaction costs and transport costs as you determine your most advantageous market. Okay, so basing on this highlight, from this question we have here, you are told that SECU market has the greatest volume and level of activity for this piece of furniture. So it means that SECU market is where this furniture is being transacted with what? With highest volume. So that one will be your principal market. And once you identify the principal market, you don't need to to what about the most advantageous market. That will be all. CPA market will help you to know the fair value of this asset. How? That's what we are going to do. Now, to know the fair value, we are going to say that the principal market from this, the principal market is the CPA market. CPA market, since it has the greatest or the highest, the greatest volume of transaction for the piece of furniture. And IFRS 13, that is fair value. So you will say so. Or you use it. Therefore, the fair value, let me just say the fair value will be determined according to will be determined as below. As below. You say as per IFRS 13, that is fair value measurement. Fair value measurement. Remember, as you answer, at least you need to bring the standard. You need to bring a standard in your statement. Okay. So we are going to rely on the CPA market. We just put here shillings. Then we determine the fair value. How much would you receive? The consideration received, the amount you can receive from the CPA market. That will be your the fair value. Okay. So you get your price to be received. Then you simply less the transportation cost. Remember the fair value. When I was explaining this fair value at the start, the fair value, always know that fair value is the price you would receive to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. But as you get that fair value, you must less the transportation cost. The amount to receive minus the transportation or the cost to sell. The cost to sell is your transportation cost. You don't look at the transaction cost. Transaction cost will be applied in a situation where you don't have principal market and you want to use you want to determine what is the most advantageous market. That's where you can use the transaction cost. But as long as you have the principal market, for you, as you get your fair value, simply get the price to be received, then you remove the cost to sell, that is the transportation cost. And we are given transportation cost as how much? We are given the transportation cost as how much?
The handout I have doesn't have the question. I don't have the QB yet.
Okay, so we have the transportation, or the transport cost is 80,000. So that's what you're going to record here, 80,000. Okay. So finally, you will get your fair value your fair value of this furniture. The fair value will be, you simply get this figure, then you subtract 80,000. That's what you will get. Okay, that will be your fair value. Why do we neglect, or why do we exclude the transaction cost in a situation where we have the principal market? We exclude transaction cost because it's assumed that it's insufficient in a way that you already know the principal market. You already know where your market for that asset is. You don't need to incur transaction costs. Remember, these transaction costs are like the costs you're going to pay, for example, to look for brokers. Those the cost you pay, the cost you pay to those brokers, so that they can get market for your commodity or for your asset. Those are transaction costs. But in this situation, already you know the market. You know the market, so you cannot incur that we cannot include that transaction cost. Okay, that's why we exclude the transaction cost as we determine the fair value. Once I know the market, I don't need to incur the transaction cost. No. I simply get the price to be received, then minus the transportation cost. And that's all. That's all. That's all. Now, that's all. You have the fair value of the furniture. So it means that as you do your computations, probably as that question one, you will be relying on this fair value to do any other. But for now, since we are not doing the whole of that question one, we are going to move to the next question. Just I wanted to help you to know how you can get the fair value if it's not given. If it's not given. Okay. Okay. So next question is May 2019. About this standard, May 2019. May 2019. Question 3, part B. Question 3, part B. Let's see, also open that question and we see. Okay, which screen are you still seeing?
The Excel.
Okay, let me try to. We are looking for May 2019. Okay, May 2019. Okay, May 2019. It's here. May 2019 question what? Question 3. Okay, it's here. 10. You have 10 marks. You have 10 marks. Part B. Part B. They are telling us we determine the fair value of the weighing scale. Determine the fair value of the weighing scale in accordance with the requirements of IFRS 13, that is fair value measurement. Okay. What are you given? You are told that BPL wants to sell some of its heavy duty weighing machines that are no longer in use. 2 markets were found within Kampala, Kiseku market and the Kasenyi market. Management of BPL assessed the following information from both markets at the measurement date. You have two markets and you're told that this is the price that would be received from each market. You have the transaction costs, you have the transport costs. You are told that none of the markets is the principal market for weighing scales. None of the markets is the principal market. This is very, very key. You don't have the principal market. So in a situation where you don't have the principal market, I say that you must now look for the most advantageous market. Yes, please. The question?
No, not
okay.
from.
So in a situation where you don't have the principal market, as I said, is that market where that asset is being transacted with the highest volume. When you go to that market, you find a lot of identical assets in that market being sold. Okay, or you have a lot of assets being sold in that market, as it must be identical. Now, in the situation where you don't have the principal market, you must immediately determine the most advantageous market. So how do you get the most advantageous market? Okay, so here you will say, since the principal market is not given, this company called what? BPL shall determine, or must determine the most advantageous market. And the most advantageous market is the market that is the market with the highest economic benefit, where you can gain more. Where you can gain more. If you sell your asset, where can you gain more? In which market? So you will look at two markets. You have Steku, you have Kasenyi. Okay. First wait just a minute. Then here you can put shillings and shillings. Now we are looking for the net benefit. And as I explained, most advantageous market. When you're looking for the most advantageous market, you take into consideration the transaction costs and the transport costs, because at this point you don't know the right market. So you will have also to incur. You also have to incur the transaction costs to look for the what? To look for the market where you can benefit more. So it means that when you're determining most advantageous, you're going to get the price to be received, from each market. From Kiseku market, you can receive how much? You can receive 2 million. Then from Kasenyi, you receive 1.8. Okay, you put it there. Yeah, so this, then here it's 1.8. Then from this you remove the transaction. You remove the transaction cost.
700 and 400 for Kasenyi.
Okay, so we have the transaction cost. And here it's what, 700?
700,000.
700,000 for you. You put the amount in a bracket. Then here for Kasenyi is how much?
100,000.
400,000. Okay. Then you again raise the transport cost. The transport cost.
200,000 for each.
So here it's 200. Then here is also 200. Then you look for the net benefit. The net benefit. You just use your calculator. This minus all these. Okay. That's what I have here. Then that's what I have. So from this, what will be your most advantageous market? Where you benefit more. So you say that the most advantageous market is Kasenyi market, since it has the highest economic benefit. So as you know your most advantageous market, you will say that therefore the fair value, I can say that. Okay, I can say the fair value therefore be determined from the market, from this Kasenyi market as below. So now once you know your most advantageous market, you follow these steps. You simply get, now you will be basing on the Kasenyi market, and you get your fair value of our weighing scale. Our weighing scale will be I get the price to be received. Then I remove. Remember, once you know the market, now you don't again talk about the transaction cost as you determine your fair value. You simply look at the price to be received, then you remove the transport costs, full stop. So you remove the transport cost. So here you have the price to be received.
1.8
is 1.8. Then the transport costs, it's 200. Then overall, what will be our fair value? The fair value, you subtract this minus 200, which is 1.6. That will be our fair value. That will be our fair value. Okay. And you have your max. Just that in an exam, when you see like you have 10 marks for this part, it means that you need to also first tell the examiner what is all about the meaning of fair value. Okay, at least you talk about the standard. You talk about the meaning of the fair value. Then you talk about the assumption about this fair value measurement. It assumes that the transaction to sell the asset, or of course here maybe I can put a note. I can put, but you have those things in your handout. I shared those things. I don't need to waste time. I share. Just to note it. Just to note that the fair value measurement, should not be adjusted for a transaction. Should not be adjusted for transaction costs. That's something you must know, because the rules of the fair value measurement, because the rules of the fair value measurement assumes that there are insufficient, sorry, is insignificant or minimal transaction cost. Why do they assume that there are minimal transaction costs? Because already you know the market. So you don't need to again, once you know the market, so you don't need to again incur those transaction costs. Yeah, sometimes you can incur, but at a minimal cost. So for you in an exam, don't, as you determine your fair value, don't subtract the transaction cost. Okay.
Yes, please.
Okay. That's all about the standard. If you're to look for fair value, but read the theory. Any question about this? Okay, let's go to another standard. That is the IAS 36. The impairment of asset. So what is impairment? Do you understand the meaning of impairment? What is impairment? What is impairment? Impairment, simply here, it's a fall in the what? In the value of the asset, in the value of asset. For example, here you'll find that for you to know that there is impairment, you look at two things. You compare. Here you compare impairment happen in a situation. Impairment happen in a situation where the carrying value of an asset is higher than the recoverable amount. So once you realize that the carrying value of an asset is higher than the recoverable amount, automatically there would be an impairment. The difference is impairment. And what is the carrying value? What is the carrying value or the carrying amount? The carrying amount is simply the value, means the value the value at which the asset is reflected in the statement of financial position. If we look at our balance sheet, what is the value of that asset? All that debt. Remember what we put in the balance sheet. As you determine your carrying amount, the value that is reflected in the balance sheet will always be the cost minus accumulated depreciation. That is your carrying amount. It can be cost minus accumulated depreciation or accumulated amortization, depending on the kind of asset you're dealing with. Okay, that is the carrying amount. What about the recoverable amount? The recoverable amount. This is the higher of, we look at two things as we get the recoverable amount. So you will look at one. You look at number one. Number one, you're going to look at the fair value. The fair value less costs to sale. The price to be received on the sale of asset less any cost to sell that asset. The cost to sell that asset, here we are only trying to talk about the transport costs. Don't talk about the advertising costs. Don't talk about the advertising costs. Then number two, you look at the value in use. The value in use. And what is the value in use? This is the present value of the future cash flow expected from the asset. Expected from the asset. If you are to use this asset, what do you expect to generate each year? Because that asset you're holding at the company, it's giving some benefit, okay? Probably if you use that asset, you may find that you're going to receive like cash inflow of 20 million in the first year, 30 million in the third year, or 10 million in 20 million in first year, 30 million in the second year, and 10 million in the third year. Now, these are your cash flows. These are your cash inflows because this is asset. Now, the moment you find that you have different cash flows in each year, then you must discount because you need to get the present value. So you discount to get the present value. This is your cash flow, then you discount the discount factor. The discount factor it will be given in the next. If you are asked about this, they must provide the cost of capital in the question or the discount factor. It can be at 10%. So you discount your future cash flows expected from this asset. So you discount to get the present value. So how do you discount? Because for you, you're not provided with a table. So how do you discount? You get 1 plus like a formula, 1 plus R, then power negative 8. So you substitute in your formula. So it means that you simply get you get the percentage. It will be simply 1.1 because R is 10%, which is the same as 0.1. 0.1 plus 1, you get 1.1. So it's 1.1 power n. Now, if you're dealing with year 1, it is power -1. If you're dealing with year 2, it's power -2. Year 3 is power -3. Then you get here. So tell me the values here. Tell me the values. 1.1 power -1. What do you get? That is 0. What? 0.909. That's what you have. Round off 3 decimal points. Then here it's 1.1 power -2. That's what I have. 3 decimal points. And 3 decimal points. Then here it's 1.1 power -3. So once you have your present values, you go ahead and get the once you have your discount factors, you go ahead and get your present value, which is this figure, the discount factor times the cash flow, 20 million. Okay. Then here it's this figure times 30 million. Then here, let me put this figure. Because I'm even if you round off the whole number. Then here it's this figure times the 10 million. So the total present value will be value in use. So what will be your total present value? Present value, the total present value or the value in use, will be you add. So in an exam, examiner must give you the value in use, especially where he is testing you to see whether you know the this concept that you compare and take the higher. He will give you the cash flows for each year, then you use those cash flows to get the present value. Okay. You will also be given, let's say, the estimated selling price and the estimated cost to sell. If the selling price is 10 million, if let's say the selling price is 80 million, let me say the 80 million, then you remove the cost to sell like 10, you will be left with 70. Okay, 70 million. So you have to, for you to know the recoverable amount, you compare, you take the higher. Okay. In a situation where you cannot, can you hear me?
Yeah, I can hear you.
Okay. In a situation where you cannot tell the fair value, where it's hard to know the fair value, then you can simply use the value in use. In a situation where you cannot get the value in use, then you can simply rely on the fair value. So you may find that in the question, it's hard to determine the value in use because you're not given the expected cash flows from this asset. But as long as you can get these two, then you compare and take the higher. So that's all. So it means that in a situation where you're carrying amount, let's say here in the balance sheet, add at this date, assume here our asset had let's say 100 million, the value in the balance sheet. So it means that you compare this is your carrying amount, what is the higher between fair value and value in use? Here you will be having the carrying value as 100. Let me use like, yeah, let me use like 90 or 7, or yeah, let me use 90. Okay, but still the same. Here, let me put 90 million. Then what will be the recoverable amount? What will be the recoverable amount from our working? What will be the recoverable amount?
70.
You take the higher bit. Compare the two and take the higher. So here you put 70 as your recoverable amount. So the question is your asset impaired or not? Is your asset impaired or not? You can only recover if you sell your asset. You can only recover this money. Okay? But
Yeah.
in your books, you see that the value of asset is 90. So the question is, do you have impairment or not?
Yes, we do.
The asset is impaired by 20 million. So here you have the impairment loss. You have the impairment loss. Remember, impairment loss is an expense. So in your income statement, under administrative expenses, you have to indicate impairment of this. Then in your balance sheet, you must record the recoverable amount, not the carrying amount. In short, here the entries you're recognizing is to debit the profit or loss, your expense, the expense account. You're debiting the profit or loss account. This is like the impairment loss expense account. Impairment loss expense account with 20 million. Then you credit the asset. The value of the asset has reduced. So if your asset initially had the value of 90, this value has reduced by 20 million. That's why we are crediting the asset. We are reducing this. Every time you're crediting an asset, you're reducing the asset. So you're crediting the PPE account by 20 million. So it means that in your balance sheet, we expect you to have an asset at 70 million. And also going forward, as you depreciate your asset, you must depreciate based on the recoverable amount. Okay? Based on the recoverable amount. Okay. Okay. Is that clear? So, I just write a simple example. Like this one, it's like I have explained, no need of writing. Now, what could be indicators? What could be indicators of impairment? Indicators of impairment. Indicators of impairment. What are some of the things you're going to look at to tell that indeed this can cause an asset to be impaired? It's like now you're saying that now as my asset is 90, but you realize that if you can recover this. So what are those situations? What are those indicators that may tell you that indeed the recoverable amount may be low? These indicators can be internal indicators or factors, internal, and we can also have external. So an examiner can say, you explain the external indicators of impairment, and for you, you only know internal. So it's good to know the internal factors and the external factors. Internal factors, internal factors.
Damage of the asset.
Damage of the asset. Yeah. If your asset is damaged, you cannot sell at a higher price. The value of that asset will automatically reduce. That means in a case the asset is damaged. Okay. We can say in the case of physical damage of an asset. In the case of physical damage of an asset. Yeah. As long as the asset has some damages, you have to sell it at a lower price. Okay. That is like deterioration. Then number 2, reduction. You had said reduction in efficiency.
Yes.
Okay. Reduction in efficiencies. Another person can say significant reduction. Significant reduction in the actual cash flows. In the actual cash flow than the budgeted one. That means the same. Next. If you realize that several times you're repairing the asset, every time, frequently, it may not be damaged, but you finding every time you're repairing or you're incurring maintenance cost, the repair and maintenance cost, maintenance of the asset. This one can also be, these are just indicators. These are just indicators, okay? Then next, operating loss. Operating loss or net cash flow. Operating loss from as a result of using operating at a loss. I can say operating at a loss as a result of is the task. Okay. Then external factors. If there is change in the market value. Here, one, you can look at the fall or the fall in the market value. If the market value has reduced, automatically it can be also an indicator that at the end you're going to receive a lesser amount. Okay. Next, change in someone had talked about the technology. Change in the technology. For example, now there are some situations where the technology can affect you highly, and you end up not meeting your targets. Okay. Then what else? If you remember, as we determine the value in use, we normally use the cost of capital or the rate. So if you realize that this rate has increased, it can also be an indicator. So increase, because increase in the interest rates, increase in interest rates can affect your discount factor, can affect your discount rate of the entity. And you end up getting the value in use, which is actually lower. Which is actually lower. If there is decrease in the demand, decrease in the demand, of the product related to your what? To your asset. Decrease in demand means that you're going to sell less, and at the end, you will not get this fair value. Here, the fair value will be less, or you will try to reduce it. Even here, maybe another way of putting following the market value is where you can put a reduction in the selling price. Decrease. Yeah, a decrease in the selling price can also affect this figure. It can also affect what you expect to receive, your expected cash flows. These ones can reduce. Okay, so remember, every time these figures are reducing, it means that at the end, you'll get the lower recoverable amount, which is lower than the what? Lower than the carrying amount. So you will look at October. You look at October 2021. You look at October 2021. You will get a question about. Let's see what is there. Let's see what is there. October 2021. October 2021. Are you seeing this? Are you in position to see my screen?
Yes, please, we can. We can.
So you have 8 marks from once you score these 8 marks, you'll be left with 42 to pass the paper. In accordance with IAS 36, impairment of asset explains the management of this, the external and internal indicator that may reflect the existence of impairment loss. So you have to separate internal and external. And I think that's all. Okay. Let's proceed. Let's proceed to other. Let's proceed to other things. Okay. So accounting for revaluation, again, and the impairment. Take note. Let me just say an asset has a carrying value or carrying value of amount of, let's say, of the shillings 20 million. Okay, on 1st January 2021. Okay, let me just say that the asset was revalued to shillings 30 million on the same date. Okay. An impairment review. An impairment review on 31st December 2021. Now, in an exam, of course, you will be given like this transaction. You'll be given like this statement, and it's you to know, to interpret and know what you're going to apply. When you see this, immediately something should come into your mind. Okay. This was an exam. This was just a past paper number, but I'm just picking this statement. Okay. So how do you handle this? When they say show how the asset will be accounted for in 2021, it means that here they are not specific. You can look for what will be recorded in the income statement and the balance sheet. Okay. So here you will need to do some workings. You have the carrying value at the start of the year. Which was 20 million. Okay, it was 20 million. Let me put it here. 20 million. Okay. Then you have on this same date, that is carrying value at the start of the year, 1st January 2021. Then you are told that the asset was revalued to 30 million on the same date. So you have the revalued amount on the same date, 1st January 2021, the same amount. Sorry. The revalued amount is 30 million. Okay. Now, in a situation where you have such kind of information, you need to test and see whether you have a revaluation gain or a loss. Do you have a revaluation gain or revaluation loss here? This is revaluation gain. This is revaluation gain of 10 million. The carrying value is this, but the revalued amount means that now the value of the asset has increased, and if you sell, you get, if you to revalue here, you immediately get the revaluation gain. Okay, now you have the revaluation gain. All that this is all that 1st January 2021. Okay. Now remember, you want what should be reported in 2021. That is at the end of 2021. In other words, so it means that all that 31st December 2021, you need to know what will be your carrying amount. What will be your carrying amount? What will be your carrying amount? At this date, the carrying amount is, because here we don't have depreciation things here, so the carrying amount will still is this. Just I want to explain the concept of revaluation and the revaluation and the impairment. 20 million, then the recoverable amount, the recoverable amount. The recoverable amount was given as what? The recoverable amount was given as 12 million. This should be the same data. Let's use the same data here. The same date. So the recoverable amount still on the same date. It's this. So what will happen is that compare the two. What did we say with impairment? You compare the two, because here you cannot. Here already you have the recoverable amount. You don't need to look for the fair value less cost to sell and compare it with value in use. That one, you have the recoverable amount direct. So no need of comparing. So here the question is, is the asset impaired or not? Here the asset is impaired. You can only recover this. So here you have the impairment. You have the impairment loss. The impairment loss of how much? 80 million. Oh. The impairment loss of 80 million. Okay, so what do you do if you find that you have that scenario in the question? You have the carrying amount, you have the revalued amount, you have the recoverable amount. What do you do? So in that situation, what do you do? Of course, here it means that initially, like here, for the first revaluation gain, you debited the asset, the value of the asset increased that by 10 million. Then the income, the other comprehensive income, revaluation gain goes to OCI, not profit or loss. So other comprehensive income also increased by 10 million. It's like a gain. Okay, then here, if it's impairment, you're debiting PL. You're debiting PL, and that's what you would have done. You debit PL and credit the asset. But what you will do in this case, in this case, the impairment loss, the impairment loss of the impairment loss of 8 million, the impairment loss of 8 million reverses, initially reverses the previous gain, the previous gain in OCI. You first reverse that gain in OCI. You first remove that gain in OCI, and the balance of what? The balance of I think my test is my test. Let me first write here. If we are to reverse, let me first write here, and I see the do we have, okay. Initially we had the OCI of 10, and now the impairment loss is 8. So if you are to reverse, you first debit, you reverse, you debit, we don't have a balance. You debit OCI, as a reversal of the previous gain, revaluation gain, by 8 million. This one by 8 million. Okay. So it means if you reverse that, it means it means now the OCI you have, it means that now here you credit, because we are trying to reverse. Already also the asset was debited, so you also reverse that 8. You credit the asset. You also do the same here by 8 million. So what does that one mean? It means that in your records, it means that in your record the asset, it means that the asset will be carried at the recoverable amount of 8 million. That's what you do. That's what you do. Cash generating unit. What is a cash generating unit? It's just in a situation where you cannot tell the amount you can generate from one. Let's say you have assets. We have different assets, but you cannot tell each asset is generating how much. But you have the gain. You have the gain. You're getting the gain. For example, like chairs. Some they can be there, but you cannot know from these chairs I am in a position to generate what, but it contributes to what you're getting as a company. So you will be having different assets that make a unit. You have a lot of different assets that can make a unit. And you realize that in that situation, it is hard it is not possible to determine the value in use of the asset, of one asset. It's hard. Okay, so in that situation, we must apply the knowledge of cash generating unit. Cash generating unit, a cash generating unit. My colleagues, we have a break of like five minutes, then we continue. Is it?
We should continue.
We just we'll continue. Okay, a cash generating unit is the smallest identifiable group of assets combining to generate cash flow. Generate cash flows. That is the cash generating unit. Okay. When a cash generating unit, just when a cash generating unit is impaired, the carrying value of the CGU is compared to the recoverable amount as a whole. And if it is impaired, when the CG unit is impaired, okay, that impairment loss, the difference, the impairment loss will be allocated as follows. So that loss must be allocated in this order. One, you have to first allocate to obviously damaged or destroyed asset. In a question, they can give you those kind of destroyed or damaged assets. So you first allocate part of the impairments to this. Then number two, you allocate the next to goodwill. You allocate the next to the goodwill allocated. If you have the goodwill allocated to, if you find that part of your CGU you have goodwill, then immediately allocate the impairment to this goodwill. CGU, allocated to CGU. Okay. Then number three, the balance to the other assets, you allocate the balance to the other assets on a pro rata basis. On a pro rata basis. On a pro rata basis. Okay. So how are we going to deal with this? How are we going to deal with this? Okay. I don't know whether we have. You write this. You write this. A CGU comprises of the following assets. Okay. You have the assets You have the assets one, you have buildings. In your CG, you have the motor vehicles. You have the motor vehicles. You have the goodwill. You have the inventory. You have the plant and the equipment. Then they are corresponding, they are carrying amounts. You have the carrying amounts. Carrying amounts. You have the carrying amounts here for building. You can put 320 million. Then for the vehicle, you can put the 40 million. Then for goodwill, you can put the 80 million. Then inventory, put the 200 million. Then for plant and equipment, put 60 million. Then the additional information telling you during the year, one of the vehicles, one of the motor vehicles. This is one of the motor vehicle. Was an SCC episode. One of the motor vehicles got involved in an accident, and got totally destroyed. Okay, and this asset, this vehicle, it's carrying amount. Its carrying amount was shillings 20 million. Okay, an impairment review. Estimated the recoverable amount of the CGU as shillings 550 million. Okay, required. You show how the impairment loss will be allocated. How the impairment loss will be allocated to each asset in CGU. 10 marks. So how do you handle this? How do you handle this? Okay. Okay, in an example, you first write like this. You first write something about what is the CGU. Okay, when the CG is impaired, what happens? How do you allocate the impairment loss? That is according to IAS 36. Now, you have the carrying amount. You have the carrying amount of the CGU, the cash generating unit. Can you get the carrying amount of the cash generating unit? The carrying amount. From this, we have the carrying amounts. So I can simply add. If you add, what do you get? You add for me all these ones. What do you get? The total. You try to add for me this and tell me the total.
$700.
700. 700 million. Okay, so that is our carrying amount. Okay, that is our carrying amount. Then the recoverable amount. The recoverable amount is what? Of the CGU. Of course, here you are trying to get the impairment. The recoverable amount, you're told that the recoverable amount is 550 million. Is this CGU impaired or not? It's impaired. The CGU is impaired. That's what you write. The CGU is impaired since the carrying amount is higher than the recoverable amount.
Abel.
Yes, please.
520. Oh, I have wrong figures.
520 where?
The carrying amount for the CGU. Let's scroll back up.
When you add this,
Let me see.
you add and see. What do you get? 320 plus 40 plus 80 plus 200 plus 60.
80 plus 20, 100, 40 plus.
It is 200. This is 200.
Oh, okay. That's the error. Thank you.
Okay. Okay, so here our CGU is impaired. Here you have the impairment. You have the impairment loss of. You have the impairment loss of what? The difference is the 150 million. That is the impairment loss. And this impairment loss, the standard say that you must allocate this impairment loss following this order. So you must follow this order as you allocate. Okay. So the impairment loss, the impairment loss of shillings 150 million will be allocated as follows. It will be allocated as follows. One, you first allocate to the damaged asset. It was destroyed the motor vehicle, and its carrying value was 20. So out of 150, you allocate 20. Okay, you allocate 20. Then number two, remember you keep asking yourself what is the balance. Now you're left with 130. Then next, you allocate to the goodwill. The goodwill allocated to this, allocated to this CG, allocated to CGU. And that's how much? The one allocated to this is the goodwill we have here is 80. So 80. You put here 80. Okay. Then next we look at others. We look at other assets. You allocate the remaining impairments to other assets on a pro rata basis. On a pro rata basis. And what are you going to allocate? Remember, as you allocate, please remember there are assets that we have some of the assets where we don't apply IAS 36. So here, this is where examiner will catch you. He will even include those assets that are not covered by IAS 36. Then for you, you make mistake. So the assets that are not covered by IAS 36 must be excluded as you allocate. So it means that you are going to allocate impairment loss to what and what? This one, to buildings, okay? By the way, what is the remaining? What is the remaining? What is the here? What is the remaining? What is the remaining impairment loss? The remaining impairment loss is 150 minus 20 million minus 80 million. What do you get? $150, $130, $80. You get you get what? You get, that is 100, you get 50 million. That is the remaining impairment loss that must be allocated. Now, this the remaining assets to be allocated, the remaining assets be allocated. The remaining assets to be allocated, we list them. One, you have buildings. Number two, do you still have a vehicle? The vehicle was 40, the vehicle that was destroyed had a carrying value of 20. So it means that you still have a vehicle. You still have a vehicle, motor vehicle. You still have motor vehicle. The balance, 40 million minus 20, because already you have allocated that. So yeah, you have this figure. You have this. Then here you have 20 million. Then next, you have what? Let me see. Goodwill, you're done. Are you going to put inventory?
No.
We said inventory is not part. Inventory is not part. So inventory is covered under IAS 2. So you don't put, you don't allocate impairment to inventory. Okay. So here you look at only the plant and equipment. And the plant and equipment, it's how much? 60. So if you add the total, what do you get? You try to add from here. This is 40, this is 400. This is 400 million. So once you have this total, it becomes easy. Now allocate the loss of 50 million. 50 million on pro rata basis. How for the build? Let me just copy this. For the building, as you allocate for the building, it will be pro rata basis. You get the portion for the building, that is 320 million over the total 400. Then multiply by the total loss 50. That will be the portion for the building. So it is 320 million, 320 times 320 over 400, then times what? Times 50. My figures are in millions, shillings in million. You do the same for the vehicle. 20, this 20 million over the 400 million, then times 50. What do you get? 20 million over 400, then times 50. That's what I have. Then equipment, but yeah, 60 million over 400 million, then times 50. What do you get? 60 times the 60 over 400 times 50. Okay. So once you do that, come down and put here the asset, put here the carrying, put here the asset, then put here the carrying amount before impairment, then next put impairment loss, just a table, impairment loss, then put the carrying amount, after impairment loss. So you need those 4 columns. Why? We needed to know how is each asset will be left at how much. So you have the assets, you have buildings. You list all these assets the way you have them, the same way we have them here. We can list them, okay? And their corresponding impairment. Then what is the impairment for the building? What is the impairment loss for the building? This is your impairment loss for each. Impairment loss for each. So for building, it is what? It's 40, isn't it? So you put that one in a bracket. 40 million. Okay. You put that 40 million in bracket. 40 million. What about for motor vehicles? Motor vehicles 2.5. But remember, it's not only 2.5. Already you have allocated the other 20. Are we together, colleagues? You had allocated the other 20. Are we together? So it will be the total impairment for the vehicle. It's 20 million plus the 2.5. Let me hope we are together. Then
Yes.
goodwill, we allocated everything, 80 million. Then this is also in bracket. Then plant and equipment, sorry, inventory, nothing. Then plant and equipment, 7.5 million. So finally, what will be your impairment, rather your carrying amount after loss? The total you get here must be 550. You try to get for me the values here. The value here is how much? 280. Then here 17.5. Then here 0. Then here 200. Then here when you subtract, when you get 60, that is 52.5 million. Colleagues, when you add these values, do you get this? When you add these values, do you get this?
Yes.
Okay. So this means that therefore the carrying the cash generating unit will now be carried at the recoverable amount of shillings 550 million. Subsequently, that's what this the CG will be carried at. And that's all with this question. But take note that as you allocate for this impairment, the carrying value of an asset, take note that in allocating an impairment loss, the carrying amount of an asset should not be reduced below the highest of one, its fair value, if you have its fair value less costs to sell. Then number two, its value in use. Because you may be given in an exam, you may be given the fair value of, let's say, the building. You may be given the fair value of the building and given its fair value in use. Remember, we take the higher between this. So as you allocate the impairment, you need also to keep monitoring what you're getting here. It should not go below. It should not be reduced below the highest of this. So if you realize that you're going below this, then you limit the figure to put here, so that you can allocate the impairment up to a tune that can give you this. In short, we are saying what you're putting here should not be below this. Okay. So colleagues, I think that's all. Question to guide October 2021. Question 4. This is the FR. FR paper. Do you have that paper? Let me open it. Here we are looking at October 2021. Okay, which screen are you seeing? Which screen are you seeing?
Worksheet. No, past paper.
Okay. So I want you to look at this. You have 12 marks. You are told that SBE is a music entertainment group that offers just a minute. Someone is in. Okay, that offers entertainment services at various events and functions. To achieve its objective of offering quality services, CBE requires registration rights of famous entertainers and musicians. On 1st April 2019, the company paid 22 million to TBS to acquire single registration rights. Here you are acquiring rights. This is intangible asset. Remember, intangible assets are catered for under IAS 38. So this is intangible asset. During the year ended the 31st March 2020, Mambo's performance was good at the start, but later deteriorated. Okay, this affected the quality of entertainment provided. Remember, this is one of the conditions for impairment. This affected the quality of the entertainment provided, and SBE lost performances worth 8 million. SBE has a performing team. The company has a performing team of 8 entertainers. This is also very, very key. And Mambo performs in all entertainments. This Mambo is one of the what? Mambo is one of singers or Mambo performers. Okay. He's also one of the entertainers. Remember, we have 8. No musician can offer a stand-alone entertainment without being in a group of 8 entertainers. This clearly tells you that this is a CGU, where you have to work together to generate a cash flow. When you're not in a group, you cannot perform. So here they are telling you, no musician can offer a standalone entertainment without being in a group of 8. The carrying value and the value in use of SBE non-current assets are that 31st March 2020 were as follows. You have the carrying values, you have also the value in use. What I was telling you, okay? Now here you're given the value in use, okay? You have the single registration rights, okay? Then you have other non-current assets. Remember, this is intangible asset. This is intangible asset, which are accounted for under IAS 38. For us, we are interested in IAS 36, other non-current assets you have. The market conditions existing on the same date revealed that an offer of 150 had been given to the directors of this a new entertainment company. Okay, this is like a consideration to be received if you accept the offer. This is like the price to receive. But they are telling you if this offer is accepted, the company would incur related costs too. So this is the cost to sell. This is like your cost to sell. Okay. So you will have the fair value minus cost to sell, compare it with the value in use, see which one is higher. Okay. The management of SBE have approached you for advice on how the above transactions should be accounted. So I will not talk about IAS 38, but IAS 38 will help us to account for what? To account for acquisition of single registration rights. But here we need to talk about one, you will need to use IAS 38 to talk about that transaction of acquisition of the rights. This one will be used to account for the acquisition of the single registration rights. Okay. Whereby you're going to debit the intangible asset. You debit the intangible asset. That is the rights, the registration rights. Registration rights of what? 22. Then you credit what? You credit how did you acquire? You paid cash or bank. Cash or bank. Okay, that is number one. 22 million. Then, of course, here we are told that the Mambo's performance somewhere. The Mambo's performance was good at the start, but later deteriorated. So it means that here, once you see that, you think about applying the IAS 36. The IAS 36, that is impairment loss. Impairment loss, which requires us to compare the carrying value with the recoverable amount. But is it possible do we know the recoverable amount? Is it possible to get the recoverable amount? From this question, is it possible? Do we know the recoverable amount? When you check the question. So the recoverable amount will be, for you to know the recoverable amount, as I said, for you to know the recoverable amount, for you to know the recoverable amount, you compare the two. For you to know the recoverable amount. That's what I said at the start. You compare two things. You compare the fair value less cost to sell and value in use. Take the higher recoverable amount is the higher of these two. So you will need the value in use, the value in use, Do you have it? Then you also need the fair value less costs to sell. Do we have these two from our question? Do we have these two? Do we have these two from our question?
Yes, we have.
What is the value in use?
Go back to the question.
Okay. What is the value in use?
It is there. 1 to 2.
Yeah, it is. We have it here. We have it here. 120, 122. We have it here. 120, 122. Okay. Then do we, sorry. I have indicated it wrong here. Then what about the fair value less cost to sell? Do we have, can we get? We have, they told us that the data revealed that you can actually get 150 million, but the cost to sell are 26. So get 150 minus 26. Yeah. Get 150 million minus 26. What do you get?
124.
You get 124. So the question here is, what are you going to take as your recoverable amount? The higher, okay? We take the higher. The recoverable amount is the higher. So here the recoverable amount of our CGU, is actually 120, 124. Then what is our carrying value of this CG? What is the carrying value of this CGU? The carrying value of this CGU is 120. Okay. It's here, it's 120. So is this CGU impaired or not? Is this CGU impaired or not? I'm asking. Is this CGU impaired or not? It's not. It's not, because you can recover 124, which is higher than the CG, which is higher than the recoverable. Sorry, which is higher than the carrying value. So it means that here the CG is not impaired. Okay. This implies that the CGU is not impaired. So there is nothing to recognize as impairment loss. Okay. So in our balance sheet, In your balance sheet, you can still record this. You can still record this. You can record the recoverable amount if the amount is below the carrying value. But if the recoverable amount is still above, then you record the carrying value in your balance sheet. What else in this question that is not clear? What else in this question that is not clear? The 80 million? Are you understanding the 80 million? This affected CB lost performance is worth shilling, was worth 80 million. Now this one, this 8 million, you lost it. It was not earned. Just this affected the quality of entertainment provided, and after all, this one was not earned. So there is no way you can recognize this. Don't put the opportunity cost. This is not the cost, first of all. You lost that money because you didn't perform. Don't say that it is opportunity cost here. Here it's nothing you incurred. So nothing you earned as well. This is not revenue, this is not cost. You didn't earn this money. So it should not be recognized in SBE books. What else? I think we have talked about this, how it should be accounted. Okay, and this 22 million, this was at the start of 2019. Here, what you have is at the end of that financial year. So it means that this 22 million is already part of the carrying value. So you don't need to. You don't need to again put it there. Okay. Any other question? Because me, I see I'm done with this question. I see I'm done with this question. Okay, for part A, that's what we started with. So colleagues, that's all. You will try in November the same way, using the same knowledge. November 2023 FR paper. November, when you check November 2023. Are you seeing the paper? November 2023. It looks like I saw. I see a part C. November 2023 part C. They told us that further analysis of note number 3. You rely on note number 3. You rely on note number 3 to answer this. They are telling us that further analysis of VTA's books showed that on 30th June 2023, a standalone cash generating unit with the carrying amount, you have the carrying amount, okay? of shillings 4,000 million had the fair value of this. You have the fair value, you have the value in use at the same date. The fair value is this, the value in use is this. So compare the two and take the higher as you look for the recoverable amount. This is the carrying amount. So the recoverable amount will be the higher between this, which will be this one. Okay. So see whether you have the impairment loss. Yeah, here you will have the impairment loss. Here you will have the impairment loss. The tax base for this cash generating unit stands at shillings this. Now remember, you're given the tax base to determine the deferred tax asset. The difference between the carrying value and the tax base is not impairment. Instead, that difference helps you to get the deferred tax asset. So for you, what you do, of course, you write about the standard, you talk about something. This transaction will be accounted for in accordance with IAS 36, that is impairment of asset, which requires that if the carrying amount of an asset exceeds its recovery amount, then that asset is impaired. You look for the recoverable amount, you look for the carrying amount, then you see whether the asset is impaired. But in an exam, you can create a table like this, the carrying amount before impairment. Then here put impairment loss. Then here put, like the way we did, put here the carrying amount after impairment. You can also write as S in SF form, or you can use the table. Then here I put details. Here you will start with the carrying values. The carrying values of CGU. It was given as 4 billion. So let me say my figures are in millions, shillings in millions. Okay. Then you have the tax base. You have the tax base. The tax base was given as what? Let me see. The tax base was given as this one. Now, what is impairment loss here? What is impairment loss? Here, what you can put is the recoverable amount. The recoverable amount. That is the higher of value in use and the value in use and the value in use and the fair value minus cost still. So what is the higher? The recoverable amount. Or some people, you can leave out this, you do it separate. You first focus on this. Someone can just let me first focus on this. Me, I put here the recoverable amount. Then from there, I can put the impairment loss. Still it works. But what is the recoverable amount? Recoverable amount is higher. Is the higher of value in use and fair value less costs to sell. So what is value in use? Value in use is how much from the question. Then what the fair value less cost to sell, fair value less cost to sell. is what? From the question, we have everything. We have everything. Value in use is this. That's what we have. Value in use is this. Then the fair value less cost sale. It's not a must to give you cost sale. If you are not given cost sale, it means that that is zero. So fair value is this. Okay. So from these two, what will be your recoverable amount? The recoverable amount is how much? The recoverable amount is how much? The higher. The recoverable amount is this. But colleagues, are you still following?
We are following.
Okay. So you put that figure here. Do you have impairment? Oh, no, no impairment. Here the recoverable amount. The recoverable amount is lower, so there is impairment. Impairment of how much? This minus this. So that is your answer. Okay. Then the other for the tax base, you simply compare the carrying value of the asset, of the CGU, then with the tax base of the CGU. Here you are applying IAS 12. This is income tax. You are not applying IAS 36. You are applying income tax. So the carrying value of the CG is this one. Then the tax base of the CG. The tax base of the CG is this one. Okay. So finally, you compare the two. You will realize that as we talk about IAS 12, if you realize that the carrying value is greater than the tax base, then you have the taxable difference. The taxable difference of this one minus this one. Okay, that is the taxable difference. And the taxable difference results into a deferred tax liability, not asset. It results into a deferred tax liability. So you will have a deferred tax liability of the tax rate, which is 30% times the taxable difference, which is equal to 30 times 1050 million. That is under IAS 12, which we are going to discuss sometime. So that is your deferred tax liability, and what should be reported. That's what should be reported in the balance sheet. Under non-current liabilities, you record this. Then also under your income statement, if you're preparing an income statement, income tax expenses increases. Okay, so colleagues, that's all. That's all with that question. This one goes to profit or loss. Then in the balance sheet, you record this one as the current value of CG. Okay. Any question? That's enough really for now. That's enough for now.